Something just happened between the United States and China, and it's not being treated like a war, but it may hit much harder. Because without firing a single shot, Washington just launched an aggressive financial strike that could reshape the global economy, and it's already sending shockwaves through energy markets, semiconductor supply chains, and high-level military planning rooms around the world. Behind closed doors, they're calling it a controlled escalation. But what's actually unfolding is far more volatile and far more dangerous. This week, the U.S. government unleashed a multi-front campaign to economically kneecap China's technological rise. And for the first time, it's not just symbolic. This is a full-spectrum squeeze on China's access to artificial intelligence, quantum computing, critical raw materials, and military-adjacent infrastructure. It's precise, it's deliberate, and it's designed to inflict real damage. At the heart of this move is a new round of export restrictions on advanced semiconductors, the kind used to train AI models, build autonomous weapons, and power next-generation surveillance systems. These chips aren't just a commodity, they're the foundation of control in the 21st century. And the US just cut off the supply. Companies like Nvidia, AMD, and ASML are now barred from selling high-performance GPU and chip-making technology to key Chinese buyers. Not only that, American allies in the Netherlands, South Korea, and Japan were quietly pressured to enforce parallel restrictions. The message is clear. If China wants to build the future, they'll have to do it without the West. And it's not just chips. Buried deeper in the new restrictions are bans on quantum computing hardware, cyber defense architecture, and even certain forms of biotech, all under the justification of national security. But here's what most people still don't understand. This isn't just about tech. It's about economic dominance, global influence, and the survival of the current monetary order. For the past decade, China has been aggressively building an alternative system, one that doesn't depend on the US dollar. They rolled out cross-border digital currency pilots. They've offered yuan-based oil contracts to Middle Eastern nations, and they've accelerated BRICS expansion to draw more countries into their orbit. Until now, Washington has largely responded with words. But that era just ended. This week's restrictions mark a line in the sand, and both sides are already preparing for what comes next. Because economic war doesn't play by conventional rules. You don't see missiles, you see currency shocks, you see supply chain fractures, you see strategic capital flight from one hemisphere to another. And right now, institutional investors are scrambling to reposition. Why? Because a prolonged standoff between the US and China isn't just geopolitical theater. It's the kind of tension that reshapes inflation, energy costs, commodities pricing, and entire sectors of the global economy. Already, Chinese state media is responding with sharp threats. The People's Daily ran a front-page editorial warning of severe retaliatory consequences if the U.S. continues its pressure campaign. Behind the scenes, China is preparing its own set of countermeasures, including restrictions on rare earth mineral exports and a possible tech ban targeting American defense contractors. If that happens, the blowback won't be limited to Beijing. Every U.S. company with supply chain exposure in China, from Apple to Tesla to Boeing, is at risk of disruption. And Wall Street knows it. That's why traders are watching the bond market for signs of stress. On Monday, 10-year Treasury yields ticked upward as fears of prolonged geopolitical risk began to surface. Gold, meanwhile, surged above $3,300 an ounce, a strong signal that capital is bracing for impact. This move didn't come out of nowhere. For the past several months, intelligence briefings to senior U.S. officials have revealed a quiet acceleration in China's military-civil fusion strategy, a doctrine that blends corporate innovation with defense capability. What Washington just triggered is a direct counter to that doctrine, striking at the points where China's commercial tech sector converges with its national defense ambitions. Even more alarming is how this shift will ripple through emerging economies. Many nations in Africa, Latin America, and Southeast Asia have signed bilateral agreements with China for infrastructure, 5G networks, and digital surveillance systems. If Chinese firms get frozen out of key components, those nations may be forced to either pivot west or develop independent systems, adding new instability to already fragile regions. Meanwhile, Wall Street analysts are quietly updating their geopolitical risk models. Hedge funds are rotating out of China-exposed equities and reallocating into defense stocks, rare earth suppliers, and cybersecurity plays. This isn't just a short-term news cycle. This is capital responding to structural fragmentation. And if China accelerates de-dollarization in response, that's when the real shift begins. Because once global trade begins to seriously fragment, the foundations of the current system start to crack. That's not speculation, that's math. The sea major conflict over the past century has followed a familiar pattern. Currency instability, central bank intervention, and a flood of emergency fiscal policy. But this time, the battlefield is digital. The weapons are financial, and the stakes are nothing less than control over the future global order. Still think this isn't a war? Let's talk about Taiwan. In parallel with the economic sanctions, the U.S. just approved a new $500 million military aid package to Taiwan, the third in less than a year. And while it's being framed as routine, the timing is anything but. Because if you combine financial isolation with a sudden military injection in a contested region, you're not just sending a message, you're forcing your opponent to respond. And China's response may not be measured. Earlier this year, Chinese defense officials warned that any foreign military support for Taiwan will be considered a direct provocation. They've now deployed dozens of warships and aircraft near the island in what analysts are calling a dry-run blockade. That's not coincidence, that's a statement. And it's not just about Taiwan anymore. At the macro level, we're watching a tectonic shift, not just in economics, but in trust. Nations are now asking, can we continue to rely on U.S. tech? On Western financial infrastructure? On dollar-clearing systems that can be weaponized at any moment? The answer is becoming clearer by the day, and so is the global response. Over the past 18 months, BRICS nations have accelerated their push toward a multipolar trade system. More than 40 countries have applied for some form of membership or association, and recent discussions have hinted at a new gold or commodity-backed settlement mechanism. That's not a protest, that's preparation. Because once you lose trust in the system, the exit ramps become very real. And investors who understand this are already moving. Some are rotating into commodities, others are pouring into hard assets, and a growing number are diversifying into decentralized technologies, including Bitcoin, not just as a hedge, but as a structural bet against global fragmentation. But what's most important now is not what happens next week, it's what's being set in motion long term. Because economic wars don't end with treaties, they end with paradigm shifts. And this one is already well underway. Markets may rally one day and fall the next, but the deeper undercurrent is this. We're entering a phase of strategic decoupling, a slow-motion divorce between the world's two largest economies. And the consequences will echo for decades. The U.S. just made its position clear. No more tolerance, no more half measures, no more appeasement. From now on, it's pressure. Full spectrum, multidimensional, and deeply intentional. The question is, how will China respond? And more importantly, what happens when the rest of the world is forced to choose a side? Stay alert. The financial battlefield is shifting under our feet, and if you're not positioning ahead of the curve, you're already behind it. Subscribe for more breakdowns like this because the world isn't just changing, it's accelerating.